And in this particular note this morning, you were calling for the resignation of Peter Navarro, Robert Lighthizer, and Wilbur Ross. You say, I'm not sure how destroying shareholder wealth, damaging CEO confidence, and making the American farmer the main sacrificial lamb here after 6 years of pain on the farm is going to get us to the point of protecting and preserving our intellectual property.
Right.
Are you serious about this?
Well, I was being a wise guy on saying they're fired. I just don't like the negotiating tactics, because we have to understand the collateral damage that's impacted. Take the farmer in Iowa that's been through a 6-year bear market with crop prices falling as much as they have. And now you wake up and you say, okay, well, my biggest customer I can't sell to. Or if I do, it's going to cost me this much more. So I don't know the answer on how best to deal with China's theft of intellectual property. I'm confident that this is not the way to go about it in such a scattershot way.
I mean, the markets right now, at least, I mean, after seeing this market bounce, Patrick, it seems like they're taking it sort of in stride and really believing that this is just going to be a negotiating tactic. At the same time, the rhetoric from China has been much more hardline. They are ready to fight, and they've said that through many different officials, whether it be a spokesperson for the Ministry of Finance or whoever you want to name in the Beijing administration. They are ready to go full out here. Who should we believe?
So I think that, looking at just today, the trading today, yes, people took a step back and realized that there is some period for negotiation here. They don't go into effect right away. But, looking at it over the past couple of weeks, the prospect of trade friction, of trade conflict, has hung like a lengthening shadow over this market. And I think that there are good reasons to think of it that way. When the president tweets things like trade wars are good and easily won, when today he tweets that, well, if you're $500 billion down, what's there to lose? It makes people think that maybe he doesn't understand what is at stake and what there is to lose from U.S. exporters, from importers, consumers.
You really think
the
he
price
doesn't
effect.
understand that?
Well, he's always framed trade in a win-lose sort of way, and several times over the past several weeks has basically said that if you're running a trade deficit with a country, it's just a net negative for the U.S. economy, instead of looking at the whole composite of the trade relationship.
Many economists have lamented what they perceive to be the lack of understanding about trade deficits at the administration. I mean, day after day after day, we hear it. Peter, ultimately, we're talking about $60 billion worth of products on a multi-trillion-dollar economy. What do you think of the market reaction to that? Because those are small numbers. Is the market telling us that it actually fears a much greater escalation? Or, let me ask you, are you convinced the sell-off is all because of trade?
Well, it's $60 billion in the value of those products itself, but look at all the supply chains that feed into creating those products. So it's probably much greater than that. Now, in the context of a $18-19 trillion economy, yes, it's small, but when Wilbur Ross this morning said, oh, it's just 0.3, well, when you're only going 2.5, 0.3 is a big deal. And tell it to the small and medium-sized business owner that, oh, don't worry, you can cut your business a little bit because everything will be okay. Now, to your last point, I still think the biggest risk is the changing monetary landscape. When the Fed is shrinking their balance sheet and raising interest rates, it makes the landscape more vulnerable to these type of externalities.
But so let me ask you this. It's $50 billion of tariffs or on $50 billion worth of products. But does all of that commerce go away?
No, it just raises the cost of doing business. Right, but we also lose business. So China's going to buy their soybeans from Brazil and Argentina instead of the U.S.
And for me here...
Marginally, yes, I think that's right, but not in the entirety. It doesn't all go away.
Can I just say, I mean, if you watched what happened with the steel and aluminum tariffs, those got watered down. These tariffs don't even go into effect immediately. They have until May 22nd. We'll have a public hearing, and even months after that, China's just threatening. Is there a chance here that the bark is just bigger than the bite, and that when push comes to shove, it is just a negotiating tactic, and the market shouldn't overreact to it?
There is a lot of bark here, and it's hard to see exactly what the bite is. But for me, the problem is actually a missed opportunity. China's IP theft is a real problem. It is a huge problem. It's cost a lot of American companies a great deal, and the U.S. is right to want to respond seriously to it. I don't think that these go-it-alone tariffs are the way to do so, nor do most U.S. companies, even including a lot of companies that are hard hit by this. We led with the steel tariff, which burned a lot of bridges with a lot of trading partners who we could actually use their help in putting pressure on China over IP theft. it was on dubious grounds, national security, that's probably going to get struck down at WTO. The Trump administration did not really coordinate and work in getting U.S. businesses on board these tariffs on IP, which means that the United States is isolated and vulnerable to Chinese retaliation in a way that we don't need to be. So I think we've missed an opportunity to put more cohesive, longer-term pressure on China on these issues by building a domestic and international coalition that could hold together in the face of Chinese retaliation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.